Just okay. Hey, Mike. Andrew here with Marketedge.Pro, and I'd like my audience to meet Michael Sidhu, and I'm going to be interviewing him on infinite banking and asking him what that's about and why it's so important for such a time as this. So, Mike, thanks for coming on board, and please just introduce yourself, how you got connected to this movement, and why you feel like it's so important for this season and this time.
Well, thanks for having me on, Andrew. And yeah, my name is, in fact, Mike Sidhu. You weren't you weren't too far off the mark there. And I've been in finance for 28 years. Originally got started in foreign exchange and then moved into banking. I was in banking for the next 17 years after my foreign exchange couple of years, and then had an opportunity to start my own financial planning practice and have been doing that since the very beginning of 2015. What first got me introduced to infinite banking? Well, I'll take you back on a bit of a journey. I'll try and make this history lesson the Cliff Notes version and not the four-year degree. When I was 22 years old, I got introduced to a book by Frederick Bastiat, and it was a book called The Law. And it's just a very short book written in the mid 1800s, and it talked about the policies of politics, the policies of government finance. And it was written after a time that he had kind of seen the after effects of the French Revolution, and then what happened with Napoleon, the tyranny of Napoleon over France. And just talking about how different government structures, he uses the word plunder a lot in that book. And that book really kind of defined for me a little bit of an opening into the freedom movement, the liberty movement. The principles kind of fell on deaf ears when I was 22, and I kind of just chucked the book to the corner and thought, that's nice. When I was 22 years old, I had different ideas on what was going on, and come back, almost 20 plus years later, when I got into finance and then had the opportunity to start my own practice. And one of the people that I met right out of getting out of the credit union system, after 19 years between that, got to know him. I love going to somebody's office and looking at their bookshelf and just kind of, what kind of books are they reading? What kind of thoughts or mindset do they have? And when I started looking at this guy's bookshelf, I was like, no, I don't know that guy, and I don't know that. I don't recognize any of these books. And then I saw on his bookshelf a copy of The Law. And I'm like, what's going on? So I asked him, so what's your philosophy? And he said, oh, we're Austrians. And I'm like, congrats, you're from Europe, and that's great. But he said, no. We believe in the Austrian School of Economics. And I'm like, okay, well, what's the Austrian school? And so he handed me a little book called Kantian's Curse. And it's written by Stephen Johnson, who runs, I believe it's Verpath Farmland Funds. It's a fund out of Calgary. And so I got to know Stephen a little bit, this author, and read his book, and it was fantastic. It really opened my eyes. Like by that time, I had been a certified financial planner for a few years. Gosh, by that time, almost a decade. And there's principles in that book that I'd never heard of. And so I started devouring knowledge and information, not only about Austrian economics, but that got me back into books like The Law and back into books that were teaching me about principles of liberty, freedom, politics, economics, all that sort of stuff. And across my travels, I had heard about, through this reading that I was doing, the infinite banking concept. And what I came to understand was that the infinite banking concept was simply how to implement Austrian economics, sound, rational principles in finance into your own life. And by doing that, you're able to reclaim the power that had been once yours, But over time, over decades, we had given more and more authority to the financial institution to not only act on our behalf, but also run this credit system, this debt-based fiat currency system. Now, some of your viewers may not understand what I just said, but basically, in summary, is we run on a system of currency where the currency has no value, and it's all done through debt financing, through government debt. And so these sort of things started really layering on my experience because I had been a financial planner since 2006. I'd been doing investments since 2002 and running my own financial planning practice. I really started implementing and instituting these principles of sound rational economics and thought into helping clients perform infinite banking, which was simply performing sound rational principles into their financial plan.
Wow, that's great. And as you can see, he has no problem sharing his ideas and his thoughts. So this is what makes Mike so powerful, is that not only does he bring the math together, but he brings the communication together and is able to eloquently explain some of these nuanced and complicated ideas and thoughts. So thanks for sharing that, and thank you for helping us understand a little bit more about what this all means. So in that, how did the IBC be created? How did it start? And how did you become a part of this movement? And then just share a little bit about what that all is and, what you guys are hoping to accomplish.
Well, it's a great question, Andrew. I think that infinite banking started back when it was discovered by R. Nelson Nash in the early 1980s. He was having some significant challenges getting some financing for some of his real estate portfolio where the mortgages were rolling over. If you think back to 1980 and 1981, 1982, when Volcker, the then chair of the US Federal Reserve, was bumping up interest rates to stave off this inflation that was cycling through the 1970s, and 5-year mortgage rates were 18, 19, 21, 22%. So Nelson had found that his real estate portfolio his mortgages might have been at 8 or 9 or 10%, but now they doubled to like 20, 21, 22%. And what he realized was that he had a significant collateral value embedded in his life insurance policies. He had the ability, the contractual ability to lend out of these contracts large values where he was able to retain the money inside the policy, but still have the benefit of using the policy values and being able to, instead of renewing his mortgages at the bank at the prevailing interest rates, he found significant savings at that time to borrow at a much lower rate through his insurance contract. What was really interesting, Andrew, is that Nelson wasn't the progenitor of the infinite banking concept, but he rather rediscovered principles that was already there. The number one way that the people specifically in US and Canada were saving money, they weren't using the bank. They were using very strategically applied whole life insurance policies and just capitalizing these policies with premiums over time, and in the event of an emergency could draw against the value of these policies by either making withdrawals or loans. And so infinite banking was reborn. And Nelson, ever since that time, financially, he rescued himself. He was basically, if he had to renew his mortgages, as you or I would, find ourselves in a bit of a pickle at 21, 22%. And hey, we're seeing people today in today's interest rate environment, they've been used to 2%, 3% mortgages. Now they're at 5, 6, 6.5%. And there's a lot of Canadians that are feeling the pinch on that. Regardless, he started banging the drum, and the consistent message was, capitalize large premiums into insurance policies where you can have a final death benefit of an insurance policy, but you had an additional living benefit of an insurance policy. And that insurance policy would provide you the security of having a large capital amount stuck inside a tax-exempt, we call them tax-exempt policies here in Canada. Incidentally, not a lot of people know this, but Jimmy Pattison actually started his whole empire. I have a letter from Jimmy, actually, where he states that if it wasn't for his cash value, the collateral value of his whole life insurance policy, he would have not been able to buy his first business, which was a car dealership on Cambie. I believe Cambie and 17th, he had a car dealership. So infinite banking started getting a little bit more popular in the 2000s. And I came to understand that there was a whole institute based out of Nelson's hometown of Birmingham, Alabama. And he was getting this message across to teach people and insurance advisors the right way to not only structure and set up a policy, the right way to use it. The institute in Alabama does do a lot of work in the US, and there's some nuances in Canada where the policies don't work exactly the same, but they're very similar in nature. And let's be honest, Andrew, the insurance industry provides a social benefit in society, and I was actually I nerd out quite a bit by reading really the things that nobody else reads, and that includes the original the Income War Tax Act by Sir White, Sir Thomas White in 1917. There was a debate in the House in September of 1917, and they were talking about how this was a conscription of wealth. At that time, Prime Minister Borden had just instituted a conscription for males from age 20 to 45 to participate in the Great War. And so in order to fund that war, Sir Thomas White suggested that we needed to raise money through taxation. And there was a lot of feedback in the Canadian political scene saying that this was not only a conscription of men to fight, but it was also a conscription of wealth. So in that Section 3 of the original Income Tax Act suggested that the death benefit of an insurance contract provided no income inclusion rates for the new act. It was really important because it was considered a widows and orphans benefit. So there's some social benefits for people to self-fund these trust pools, if you will, where a large amount of tax-free capital can be dispersed to the survivors of the insured party. However, as was true since 1847 in Canada, whole life insurance has been available to Canadians since 1847. Canada Life was the first company that offered a whole life insurance contract in Canada, and it's been around ever since. So this is going in the Wayback Machine, if you will, to be able to allow Canadians access to an asset that has been around and benefiting people for hundreds of years, literally hundreds of years in Canada. So the infinite banking today, there's approximately 46 or 47 authorized infinite banking practitioners in Canada. There's about 5 or 6 different groups of advisors I know and have met basically all of them, and appreciate all the work that they've all put in to bring the message of infinite banking to Canadians. It's been great. Currently, we started a group called the Infinite Banking Canada Group, which is a collaboration of independent financial advisors from across the country, from coast to coast. And we were just all swimming in the same direction and thought, yeah, we can collaborate by creating a mastermind and help get this message out collaboratively and help get the message of infinite banking out to Canadians.
Thanks for going full circle. That's great. Wow, you touched on a lot of important points there, and I'm wondering if next question should be about perpetual states of crisis. And you brought up 1917, I believe, with the Income War Act. And how does that tie into the Fed? And from what I understand, the Fed was created to create infinite wars and infinite fighting. And I'm wondering, with them creating that type of wealth for their systems, I'm wondering if you could touch upon how the Fed was created. And we talked about this in one of our conversations where you brought up the Fed and how it was created. And it was created in such a way that it was an appearance of wealth, appearance of money. And I was wondering if you could just touch upon that and how we can use this to bring back that wealth into our own sovereignty and how that all ties together, if you can. And hopefully
Yeah,
I'm
well,
asking the right
if I can
question.
answer that question in half an hour, I'll be a miracle worker.
Sorry.
But I actually had a conversation with G. Edward Griffin, who was the author of The Creature from Jekyll Island, and I really appreciate his vibrancy. He's 92 years old, I believe, and just sharp as a tack. Just spoke to him maybe about 5-6 months ago in an interview that's going to be released on one of our social media platforms here in the future. But he had talked and written this book called The Creature from Jekyll Island, and there's been a lot of other books written, but The Creature from Jekyll Island is probably the most well-researched and well-documented book on the foundation and the creation of the U.S. Federal Reserve. The U.S. Federal Reserve, although the government would say that it's misinformation to suggest that it's not a government agency, the U.S. Federal Reserve created in 1913, and that was simultaneously with the U.S. Income Tax Act, both by Woodrow Wilson, the President Woodrow Wilson at the time, was created in order to create a system of financial governance. They were given the power to print the currency in the time. There's a great book called The Mystery of Banking by Murray Rothbard, one of these great Austrian authors that I was referring to earlier. And in that book, he talks about the pre-iterations of the U.S. Federal Reserve. There's the First National Bank of the United States, and there's that famous quote by Thomas Jefferson that says, and I'm going to butcher it, but he says something to the effect of bankers are more dangerous than standing armies. And I won't go to the rest of the quote, but it's a brilliant soliloquy that he gave in defense of sovereign money, that Congress shall pass no law, so to speak, for a lot of things, but Congress should have retained the power of minting the currency per their original U.S. Constitution. The Bank of Canada, on the other hand, started in 1936 as a private organization and was sold to the Minister of Finance, who owns or holds in trust the million outstanding shares of this public entity. So it works a little bit differently than the U.S. Federal Reserve. However, and Paul Hellyer, who I once saw speak, Privy Council officer Paul Hellyer, back in the, I believe it was in the original Pierre Trudeau days, suggested that since 1974, the Bank of Canada takes all monetary policy direction from the Bank of International Settlements, the IMF, and the World Bank. The Bank of International Settlements, based in Basel, Switzerland, is the central bank to all central banks. And there's a lot of power in that. There's a lot of direction in that, with a lot of unelected bureaucratic people that have no accountability. There's if they get the thing wrong, if they make their policies incorrectly, then there's nothing that they stand to be voted out. Tiff Macklem, God bless him, but I pray for my leaders all the time, even though I don't agree with them. man, who pays who's accountable when he gets something wrong? Right? This is the problem I have with the amount of power. And I know this is a topic that you wanted me to touch on when we had our pre-conversation, is the amount of power that's centralized into controlling an economy. Hayek talks about this in The Road to Serfdom, is that no single committee or individual should have as much power as the current states, and state not meaning the individual states, but the state meaning the government, should have over the economic decisions of everybody. So the Bank of Canada raises and lowers interest rates by increasing or decreasing assets on the bank's reserves, and they purchase and sell assets in open market operations, and they raise and lower interest rates. We're seeing the effect of that now, a crash in the housing market. They're trying to hold off inflation, just like Paul Volcker did, but to a lesser degree from the 1970s, when, hey, let's be honest, that was an outcome of Nixon closing the Bretton Woods international monetary agreement, taking the dollar off gold redemption rights, and creating fiat currencies, where every single fiat currency in history, Andrew, has always failed, because at some point faith in the government has always failed. And when you have money that has no backing, and it doesn't matter if we're talking pieces of paper, coins, or central bank digital currency, when fiat currency, which is a fiat, is by decree, when governments say by decree that this is what the value of the dollar is, what gives us faith in the dollar? Man, it's prosperity is a bit of an illusion. When the Bank of Canada has a mandate to create a 2% inflation rate, well, my demanding question is, why? What is 2% compounding over time? That's an erosion of our purchasing power over time. So therefore, as our dollar value drops, prices go, we perceive cost of things to go up. We see housing go up, fuel go up, we're paying more at the pump, more in the grocery store. But is the prices really going up, or is the purchasing power, the exchange unit of our dollars, decreasing? Well, it's a devaluation. So by creating devaluation of our dollar through bad monetary policy, we have the illusion that we're more wealthy because the things that we own are quote unquote appreciating. I tend to disagree with that.
Wow. Is it interviewing, or am I in a training session? This is fantastic, because one of the arguments I'm making is for XRP, and how XRP is going to be replacing the fiat monetary system. I actually created a video right before this video and posted it. But I don't want to jump into that just for time's sake. And this is just a summary of infinite banking and where it's going to take us. So Pierre Poilievre just came out and said in the House of Commons that in 2026 and 2027, 40% of people are not going to be able to afford their mortgages. And so how can we use infinite banking as a hedge against what's coming? And how can we protect ourselves from what you just said, and inflation increasing at an alarming rate? And so how do people jump into this, and how do they protect their assets when it seems
That's a great
it's coming
question. Yeah,
in
there's a
such
bit
a
of a tidal
way
wave
that it
coming, don't
looks
you
like
think?
the wealth is being purposely destroyed, and
Yeah.
our fiat system is being purposely destroyed? How can we use infinite banking to protect against what's happening?
Well, let's be very clear. Infinite banking is based in the fiat currency system, right? So this is not an alternative currency. It's not an alternative to using dollars. If you put in dollars into an insurance policy and build that cash value up, you'll have access to leverage against or withdraw the cash value that's built up in that policy and has been building up on a tax-exempt basis. So the number one thing to remember is that we're not talking about alternative assets. We're talking about alternative ways to think about your money using the same currency system that we have now. The number one way to help fight inflation without increasing the risk that you take in maybe some alternative investments is to reduce the tax, right? If you can create a 5% return, but you're paying tax on it, or if you could create a 3% return and not pay any tax on it, well, who's further ahead? Well, depending on what your tax rate is, if you're earning 5% at 50% tax rate, your real net earnings are 2.5%. And then you factor inflation. Let's just say inflation was 4.4%. Well, now you're minus 5, 6, 7, 8, whatever percent. No, you're probably sitting around -2, -3% when all is said and after tax and inflation is considered. So let's remove the tax off our returns. That's the number one most efficient thing that we can do with our money. So some people consider that they'll put money into an RSP. Well, the problem with that is, what are you doing with your tax return? Well, most people go to Hawaii. Most people go buy a big screen TV and they're blowing their taxes that they will pay later, because a RSP is not a tax exempt vehicle. It's a tax deferred vehicle. So at some point you got to pay the piper. Okay. The same can be true depending on how you use your life insurance contract. The reality of the Income Tax Act is that at some point, withdrawals out of an insurance contract, which is one of the major differences between the IRS tax code in the US and the Income Tax Act here in Canada, is the taxability of withdrawals from a policy. And these are called dispositions, if we want to talk technically in the Income Tax Act language. We'll consider a withdrawal a disposition of that tax. Well, if you dispose of an asset, you're going to pay tax no matter what asset that is, other than a TFSA, and other than a principal residence if you still have the exemption, if you still qualify for the exemption. There's also the capital gains exemption that exists in the Act. However, if you collateralize through lending against that asset, it's just the same as collateralizing against a real estate portfolio. If you take a mortgage against a rental property, you're not paying tax on that rental property. Same thing with an insurance policy. If you use that insurance policy instead of cashing it out, but using that as collateral through a third party, you're not going to pay any tax on that whatsoever. Okay, you need to be careful, because if you've got corporations or any trusts or complications like that involved, you need to seek legal and tax advice on that, of course. So the number one thing is tax. The second thing is understanding participation. And what participation is who owns the money. When you make a deposit to a bank, they lend that money out at a rate of return, at an interest rate. They take their costs away, they take their profit away, and then they give you the money. Now remember that, and importantly, perhaps not a lot of your viewers understand this, but when you make a deposit at a bank, this is actually not your money while it sits in the bank. It forms part of the bank capital, and there's 5 different court cases that prove that in English Supreme Court back in the very early 1800s. So these are all loans. Who owns the money? Well, the banks own the money. So now I want to reclaim the ownership of that money. I'm the owner of an insurance contract, and the liability isn't on return of the money, but the liability is on a death benefit of the insurance policy. So it's about ownership. So number 1, tax. Number 2, ownership. And number 3 is opportunity cost. Okay, when you take your money and give it to somebody, let's just say, Andrew, you had a real estate property and you sold it to me for 200 grand. I don't know where that property would be. Maybe it's in Northwest Territory somewhere, but you've got a property for 200 grand and I give you that 200,000. Well, I now have the enjoyment of that property, but you have the enjoyment of the money. You have the 200,000. Now, who's making the return on the 200,000? Well, we have to think that wherever money sits, money accumulates a return. And so if I give you that money, if I give away, if I deploy that money, I've lost all opportunity to make money on that money essentially that I've given to you. I still have the enjoyment of the property, but what if I could get the enjoyment of the property plus hold on to my money by using leverage as a go-between in order for me to purchase that property from you? I'm not gonna. I still have the money sitting in my insurance contract. I can use it, collateralize it, purchase, use it for investment purposes, use it for whatever. The point is that I'm trying to get out of fiat money. I'm trying to use my fiat money to buy assets that appreciate, which is really the devaluation of the dollar. We've already said that, but if I think in normal person's terms, that property will appreciate over time. So I'm going to participate in the appreciation of the money. I'm paying simple interest on the loan that I have against an asset that's enjoying compounding tax exempt returns. So those are kind of my big three in terms of how do I protect myself from inflation using an insurance policy to mitigate or facilitate that.
Wow, that's fantastic. And with the 2026 and 2027 looming, do people have enough time to start investing in these policies and being able to prepare themselves for when they have to remortgage themselves and get into a new mortgage? And then this will also be my last question since we're coming up to 2 o'clock here, 2 p.m.
Yeah, I think that in understanding how infinite banking works, you have to rethink your thinking. That's one of the great rules. Nelson only had 5 rules, and one of them was rethink your thinking. And what that simply means is that do people have time? Well, that depends on what the goals are. You know, infinite banking isn't for every single Canadian. I believe that there's an opportunity for every single Canadian to participate, but it's not the right fit for everybody, right? We have to think more broadly in terms of all the strategies and things that are out there, infinite banking being one strategy of many. For example, if some of your viewers are probably thinking sovereign banking, offshore banking, bullion, crypto, all these different things. Well, how does infinite banking work in that context compared to, what our mortgage rates are going to be? Well, God bless Pierre, met him multiple times, but nobody can predict the future. We don't know what the macro factors, the macroeconomic factors are going to be that are going to influence fiscal policy being the government policy, monetary policy being the Bank of Canada policy. Man, the future's up in the air. There's only one person, if you want to call him a person, that knows the future. Anybody that says that they know the future, I can guarantee that they are the last people that know the future. So we could predict, we can say that if interest rates don't come back down and the majority of Canadians are paying much higher mortgage rates, well, that may be true. But then we also layered on top of that have a massive wealth transfer that's going on with the baby boomers are starting to pass away. And the wealth that they've accumulated is going to start flowing into the next generation. Now, the government is also going like this because they know there's not a lot of people who are doing proper tax planning, proper financial planning, and proper estate planning in order to transfer their wealth more efficiently to the next generation. So there's many different factors beyond the scope of our thinking and certainly this discussion to be able to quantifiably say that people are going to be in trouble or they're not going to be in trouble.
That's great. Thank you. And thank you for your time. And we're going to be having an event, I believe, July 20th.
Yeah, I'm super excited about that. Yeah, super excited to speak to your viewers. We're having this live event. going on LinkedIn on July 20th. And yeah, it's going to be, I think, a similar conversation, maybe get into a few more details, answer some more questions that you have about financial planning and infinite banking.
And I think we might have to extend that event to 2 hours and then have a Q&A on the back end of it, and maybe even have it at a location based upon the relevance of this topic. So that's something me and Mike will discuss, and I'll get back to our audience and discuss that as we go. So thank you very much for your time, Mike. Great insights into the space, and look forward to continuing this conversation and education.
Thanks for having me on, Andrew, and I look forward to seeing you again soon.
Okay. So you can stop the recording. That's on your end there.